Welcome to the Jay Martin Show. My guest today is Nomi Prins, who might be my favorite finance author of all time. She's the author of 8 books, including Collusion, It Takes a Pillage, All the President's Bankers. I love the names. And her newest book, Permanent Distortion, which comes out in like a week. So I was really excited to have Nomi back on the show today. When I was interviewing former Prime Minister Stephen Harper and former President Felipe Calderón at my conference in May, her book, Collusion, was one of my primary study tools to understand the mindset of those two world leaders as they navigated their crisis when they were in office, which was obviously the 2008 Great Financial Crisis. So she really is an exceptional author, amazing storyteller, and very good at communicating her arguments and ideas. This interview is an absolute treat. I love having Nomi on the show. So we dig into what her permanent distortion is and what her forecast looked like. All right, here's Nomi Prins. As always, there's a pinned comment beneath this video or in the description where you can subscribe to my weekly newsletter. I absolutely love writing it. It comes out every Sunday. It's free, and I share my key takeaways and lessons learned from conversations just like this and plenty others. Here's Nomi Prins. Enjoy.
This is Jay Martin.
Welcome to the Jay Martin Show. I'm joined right now by Nomi Prins, arguably my favorite author in the finance sector, author of 8 books, and soon to be 9th, or is soon to be 8. Okay, we can't wait for this one. I want to talk about it. So let's jump into your next release. October 11th, Permanent Distortion comes out. Right now it's available for pre-order. It's funny, we're just chatting with a paper shortage in the publishing industry, and turns out pre-ordering is not a bad idea. Give us the premise. What are you writing about for your 8th book, Nomi?
So the 8th book is about what I call permanent, and I chose that word very specifically, distortion between the financial markets, financial assets, and the real economy, in how it's perceived by everybody every day, in how it grows and how it's built, in what lasts, versus, again, this mercurial availability of still, no matter what the Fed has done recently, very cheap money underlying the entire market and financial mechanism.
And this is a bit of a pivot for you, correct? In terms of maybe a forecast you had made over the last couple of years, right? Pointing to a significant crash. And this is now evolving. The idea is changing in your mind. So walk me through that evolution of that idea.
Yeah, no, thanks for that, Jay. What it was when I was looking at writing Collusion, and when I wrote Collusion, my last book, is I went around the world. I spoke with central bankers around the world. And this was during a time where we had first had a financial crash crisis in 2008, 2009. Central banks opened their books effectively by electronically fabricating money. They grew their books to, in the Fed's case, $4.5 trillion, throughout the world, $29 trillion. And as a result of that, money did flow into markets. Eventually, we had market liftoff, and it sort of went everywhere. And then along the way, through the middle of 2019, I'd say, we had some bumps in the economies of the world, and particularly the US, or simply just a stagnation of economic growth. So if you look, for example, at just the stock market behavior versus GDP growth from the period of time between 2008 to 2019, when the Fed pivoted from raising rates a little bit between 2015 and the end of 2018 to starting to reduce them again, you see that markets always outperform the real economy on the way up, on the way down. And when we got to the pandemic, and this is where I went from thinking, all right, that can't continue. You know, there are so many problems, financial and economic problems in the world, from the standpoint of debt relative to growth, which was almost and still is at a 3-to-1 ratio, in terms of the abundance of borrowing going on just to run governments and run countries around the world, and all the leverage that was going on around the world, that at some point this had to reach some breaking point for some reason. And I outlined some of those reasons, from debt to a natural disaster to a political disaster, to, as it turned out, we had a medical disaster in the pandemic. But that at some point, the central banks could not continue to bolster everything forever. Yeah. Now, the pandemic happened in the beginning of 2020, as we know, and the Fed went on overdrive again, grew its book from, it had been a height of $4.5 trillion after the financial crisis. It went down to as much as $3.7 trillion with some roll-offs, Wall Street whined a bit in the end of 2019. It went back to 4.1 trillion, but then it zoomed up to almost $9 trillion, or double what it was in the beginning of 2020 through the pandemic. And of course, it wasn't just the Fed, it was central banks around the world. And the idea was they could help economies by creating this money and in such an abundance. And at that point, I said, there is no legal limit. That was a fact to the amount of money that any central bank can fabricate. There's no rule. No one's going to take them out of business, out of operation. They can create as much as they want, right? They have some parameters that they use to kind of calibrate that, but they can. And what Wall Street noticed at the time, and knew before that, was that no matter what happens, when push comes to shove, this abundance of cheap electronic kind of fake money is going to be there. Now, it doesn't mean it's going to be there forever. It doesn't mean it's going to be in there the same amount. And it doesn't mean that interest rates aren't going to tighten along the way. And I cover all of that in Permanent Distortion. It doesn't mean that certain commodities or food prices or metal prices or whatever might basically inflate. I also cover that. But it does mean that when there was a significant crisis, central banks will do this one thing. And that's where I pivoted from saying, all right, we're going to have bumps along the way. Obviously, the market is concerned right now about the fact that the Fed has gone and all their central banks, notably not the Bank of Japan and not the People's Bank of China, but other central banks have raised some rates. But at the end of the day, money globally is still very cheap. And the uncertainty that's coming from this particular phase of rate hikes, I think will ultimately abate when the Fed or other central banks get together and say, you know what, we're actually not helping economies. We aren't really reducing inflation. And we're going to just kind of stop for now and save our firepower in case we actually need it if economies actually do crash.
So okay, that's interesting. And I agree with you. I think that we can kick this can down the road, or the Fed can kick this can down the road far faster than anybody could ever expect. It's interesting. I had a guest on last week, Harley Bassman, who was, you might know Harley, and he was talking about a lot of the mortgage-backed security forecasts in 2003, 2004. It's like everybody points to Paulson and Burry as the two who saw the housing crash before anybody else did. In fact, they were the last to see it and got really lucky that they were the last to see it, because most of us knew in 2003, 2004, there was a real estate bubble and it was unsustainable. We began shorting the market way too early and got cleaned out. But, because you can always kick that can down the road far further than anybody expects. So therefore, is there an economic crash? Because what you said is maybe the Fed wants to reserve some dry powder in case there actually is that economic crash where they need to stimulate. So walk me through that a little bit. Is there a scenario where we do see a material crash, and why not now?
Well, when I say a material crash, we're talking about something that happens acutely, like a pandemic, like a financial crisis that causes a sort of immediate or very, very quick movement in all markets at the same time. At which point, as we've seen, the Fed and other central banks have come in to sort of liquefy, I should say, those sort of situations. And that can happen. It can happen because of a compound debt crisis. It can happen because of a political crisis that's compounded by a debt crisis. Just an example, for instance, Brazil has a lot of natural resources, a lot of commodities, has a lot of relationships with respect to those with the US and with China. It kind of, operates in that triangle between those two superpowers. But it also has political instability. It also has an incredibly stretched economy, and it has a lot of unrest in pockets throughout the country. So, for example, there could be a situation where it can't necessarily, relative to the rising dollar, repay some of its debt. It's corporate debt. It goes into more internal scandals, like we've seen in the past. There are political scandals, there are uprisings, things shut down, things don't come out, and we get a knock-on effect with banks that have, in the intermediate period with cheap money, relent to those corporations or to the country. That's just one that's big where that could happen. Obviously, there's a lot of smaller countries that don't have that kind of an impact, like a Sri Lanka, where lots of things happen wrong at the same time, and it doesn't necessarily affect the global economy or what any central bank might think or do. So it does depend on that. Of course, we never really saw the pandemic unfold as it did from before it happened, and having such a intense shutdown throughout the world. I don't necessarily think that's going to happen in that way again. But any sort of acute scenario will absolutely cause central banks to go back to this well of fabricated money and a reduction of rates. And in the case of 2019, nothing that major even happened. The Fed was raising rates from the end of 2015 by 25 basis points, another 25 basis points a year later, because 2016 was a volatile year in the world and in economies and in markets and with elections. Again, at the end of 2016, another 25 basis points, some more, up to 2.5% throughout basically the end of 2018 into 2019. And then they reversed. Why did they reverse? No big crisis. The economy was slowing down, and Wall Street was noticing that it could not trust its corporate relationships. And so the repo markets were basically drying up, and they came to the Fed and said, hey, it's a problem. The Fed reduced rates in July of 2019. So things can cause a pivot, and the need to use that dry powder that aren't even necessarily a major crash or a major crisis along the way. And that's kind of why that reserve is there. Now, we didn't have the kind of inflation that we have in food and fuel prices as we do now. We certainly had a housing bubble. We certainly had a housing bubble into the financial crash. So when the Fed talks about housing and its concern about that, the reality is raising rates does slow down the housing market a bit. It definitely slows down the mortgage market, slows down development, but at the same time, it increases rents. So it still increases the cost of people who need to live and can't afford to buy things at that level, and that keeps the inflation of housing overall as high or relatively high as it ever is or was. And then if you talk about, again, food and fuel, the Fed cannot impact that. The Fed is not like a farmer. It's no agricultural entity. It's not an oil well. It can't fabricate natural gas. And so a lot of the other things that are impacted by a combination of supply chain, political disruptions, and general economic conditions and weather conditions just are not in its purview to correct. And for those reasons as well, if there is economic slowdown, even in the face, I think, of price inflation in those spaces, which we have now, but continued so, the Fed can also decide to pivot or sort of come back from its current aggressive pace of rate hikes.
Which I kind of assume, might have to happen. Like if I walk through that, you mentioned the real necessities in life, right? Fuel, food, and shelter being the housing market, right? And you're right, it's difficult to see how the price of food or fuel is going to come down in the near future, near being like, call it a 5-year time horizon, when you look at all the geopolitical factors and just the constraints and, I guess, protectionist philosophies that are rolling out around the world in terms of gas and grain. Now, that being the case, we could probably expect prolonged inflation within those necessities, right? Food and fuel. Maybe the discretionary spending prices will come down. The car market might get smashed a little bit. I'd be curious to know your thoughts on the housing market in that regard. But, if we see continued increase in these necessities, then the quality of life will continue to get more challenging, right? And harder, right? People's affordability of any extras disappears, right? So what is your forecast, I guess, for the real economy, right? Let's just stick with America over the next decade, right? And is it a pretty picture? Is it a challenging one? Like, what do you think, Nomi?
Well, I think in general, and to an extent as a result of this permanent distortion between money effectively flowing into financial assets and markets on a more rapid basis, and even when it retracts, not going into all of the elements of the real economy that impact people's lives, I think we're going to continue to see this disconnect between markets and the real economy, whether the markets are going up or down. And I do think that we're also going to see inflated prices as long as, again, we have these sorts of geopolitical turmoils that we have right now. And yes, more of an element of both protectionism and also just a reallocation of sort of allies and alliances amongst countries as a result around the world. I mean, we look at what's happening into the winter months and what we expect to happen, or I expect to happen in the winter months in Europe, where you have this, basically sanction against one of its major suppliers. that can't not impact the price of oil, the price of natural gas. So the thing is, even if we see prices come down because there are economic slowdowns and less of, let's say, a demand on fuel, we also see that there could be other factors that could pop them back up. Now, that said, I also see that there's going to be an expansion, for example, just staying with energy, in the general field of energy. I do think the pivot, the transition to new energy, alternative energy methods, cheaper methods of storing energy, whether that's some from an alternative battery perspective to more of an upgrade to our entire electricity grid. And this isn't just about pivoting to EVs. This is about, in general, coming up with a better balance, a cheaper economic balance of how we produce and use energy in every manner, from transportation at home to keeping our homes heated. And I think what we've seen from this period is that those economies that are related and those investments that are related to that part of the economy, I think will do well in the future years, even if the overall economy staggers relative to markets.
Okay. What is your forecast, or I guess expectation within Europe this winter? Because I'm on the same page. There's been a lot of blustering about weaning ourselves, I'm talking about countries like Germany, off of Russian gas, but they don't have another option. It's easy to say that now in the summer, but temperatures are going to get cold and people are going to need to warm their house. I have to assume, if I was, a citizen in a country like Germany, and I'm expecting things like rolling blackouts as soon as November, December, right? I'm going to look at my alignment, right? And what's there for me if we continue to be an ally of the West? I'm not quite sure. What's there for me if we pivot to becoming an ally of the East? Food and fuel. Well, that's pretty attractive, right? And so, do we see a breakup of the euro and a realignment of the geopolitical chessboard?
That's a really good question. You certainly see that, that the related increased tension amongst people. When you are facing cold and the inability to heat your place or to move about without it really digging into your just general financial stability, that is a problem. If you can't afford food, or food's really prohibitively more expensive, that's a problem that causes all sorts of internal skirmishes and realignments at the domestic polls and that sort of thing. It does. We had, just going into the pandemic period and going into this inflationary period, 2019 was a year of, I talk about this in Permanent Distortion, of kind of the most civil unrest in the most places broadly around the world. And now it is much more than that. Pandemic kind of kept it on a lid, and now it's sort of coming up past that, because people get tense when they can't afford things they need. And that changes politics. And you're right, that changes some realignments. And that's one of the reasons why I think it took a while for Germany to even come out and say, we are actually going to sanction our basically number one supplier of fuel to this extent. And I think that can cause more internal fractions. So it will be interesting to see how that turns out. On the same token, the United States has used the higher fuel prices and just what's happened with respect to Russia and the East, or that region, to say, all right, well, we're going to solidify relationships with Japan. We're going to solidify relationship with Canada, with Mexico, that we already have, but more so in South America, in terms of getting what we need to supply ourselves with food and fuel, and also to more so vilify China for continuing its relationship with Russia and just in general, because that's what happens between the two powers, between the US and China. And so that bigger superpower alignment is changing with regard to the allies that supply its supply chains,
Right.
as well as looking internally to put more money and more investment, more government investment into domestic supply chains. And that's one of the reasons that we had the bipartisan infrastructure act passed at the end of last year. And it's one of the reasons why, even though it was partisan in terms of its passage, the recent Inflation Reduction Act was passed. Now, I don't think that will actually reduce inflation, but the good thing about it is it does seed fund and produce sort of tax incentives for this area of energy that's at the core of people's needs and geopolitics.
Okay, I want to jump into that in a minute because I'm curious. First, though, getting back to call it the Eastern Bloc, the BRIC nations, would you anticipate an organized replacement or option for reserve currency put forward by this Eastern Bloc? And if so, what does that look like? Is that like gold backed by oil? Is it a commodity basket? What do you see there, Nomi?
So this is actually a question I probed quite considerably back when I wrote Collusion, because at the time, Russia and China were establishing a trading mechanism by which they could effectively buy each other's produce and trade in each other's currency. So basically
Right.
outside the dollar, and create a sort of trade bloc alliance that way. And of course, we also had a large alliance created from a trade perspective, which still exists in Asia, and the United States at the time opted out of the TPA, which would have been a global alliance that would have included the US, and is now looking at a different mechanism for trade alliances. All that said, relative to currencies, what it means is that there's constantly a backdrop of the dollar, and we've seen the dollar strengthen considerably during this entire post-pandemic period, and since the Fed started raising rates as well, relative to other currencies, where the main reserve currency still remains the dollar. Why? Even if you look at China, it's got over $1 trillion worth of dollars. Bank of Japan has had over $1 trillion worth of dollars in terms of buying US debt and so forth. They don't really want to sell what they own because it will basically depreciate their portfolio. And they don't really want to do that because it doesn't make sense from an economic cash perspective, like from a just investment perspective. So there's that. But that said, also China's yen was accepted into the SDR, into the special drawing rights basket of the IMF a number of years ago. So all of those pushes to enter the global arena were made by China.
Mm-hmm.
And they were made to basically create a foundation for expanding its currency throughout the world. The reason that the dollar still remains where it is in terms of a reserve currency and where it is in terms of strength relative to other currencies is because it also has that sort of safety aspect to it. It has that trust. As much as we have so much debt in the United States, and as much as we make so many mistakes in policy in the United States, there's still well, we kind of get the US versus China. So there's still on the margin a number of countries that will continue to trade in dollars and continue to issue, to basically borrow in dollars. And I think that's why the dollar stays supreme. The gold-backed idea, I mean, that's definitely something that I think China has specifically been pushing with the IMF in terms of just getting, and I've talked about this, getting gold, is it just back into a basket, just into some kind of place where it's at least a benchmark, not a standard peg like it was before 1971. And that's something that the US continues to bash as an idea, and something that the East, in particular central banks, Russia, China, et cetera, who stockpile gold more so, continue to push because it's an edge. So the question, I'm telling you all of this in a sort of longer way because the question relates to geopolitics more than currencies. And it relates to how quickly the Eastern Bloc can get itself to be more prevalent as the currency of choice. And it had a great head start in the wake of the financial crisis of 2008, in the SDR with the yen, in the alignments that were being created, in the petro yen that can be created between Saudi Arabia and China, but net, it's going to be a long time, and I've said not in my lifetime where there's any sort of a supplant of the US dollar relative to any other single currency, or to gold. I mean, again, the best we get is I think a benchmark of some sort at the IMF or some place of that nature that also includes gold.
Yeah. Okay. I have two questions spun out of that. Number one, you mentioned USD still remains the reserve currency because of the perceived safety, right, of it. And there's a high level of trust. And that's, people can dispute that all day long, and they do. Tall poppy syndrome, they love to chop down the leader, you know what I mean, and point out all the flaws in the US dollar. However, look at the Dixie. That's all you have to say is, where do people go when things really get volatile? They're supposed to go to gold. They didn't. They went to US dollars. Luke Groman states or believes that, you know, the US sanctioning and euro sanctioning that 600 billion of currency reserves from Russia in the future, we'll look back on that moment as significant as when Nixon took the world off the gold standard in August of 1971. Do you think that US sanctioning those US dollar reserves from Russia is as dramatic of a statement and a precedent that will lead us down a new path in the future as removing the US dollar from the gold standard? Or do you think it's not that big of a deal?
Well, removing the US dollar from the gold standard in 1971 was a culmination of where oil was, the relationships of the US and OPEC, the relationship of David Rockefeller, who was at the head of Chase, and his conversations with Nixon and OPEC,
Mm.
and where the Fed was at the time, which was less of an actor. But the point being that there were a lot of reasons that ultimately Nixon pushed to get off of the gold standard, and it was a major, major, major event.
Mm.
And it absolutely created a lot of other ramifications. One of the primary ones being it allowed banks to borrow basically from the Fed, and the Fed to create money when it needed to. And we had inflation, high rates and stuff along the way, but it opened the doors for there to be no mooring of reserves versus anything solid or physical like gold. And it wasn't something obviously that just impacted the Fed in the United States, it impacted the entire world.
Yeah.
So on that basis, and it's still impacting the entire world and how central banks operate and what gold means. So on that basis, I think it was a much bigger event than the sanctioning, than the sanctioning Russia or sanctioning its central bank with respect to a smaller effective portion of money relative to that event. Is it an event? Yes. Is it a political statement? Yes. Is it something that basically creates less trust between the countries? Yes. But I still think that the major event remains taking the US off the gold standard.
Okay. Yeah. To date, it's not comparable. Now, I think where Luke's coming from is, I believe, and I might have these numbers wrong, over the last years, central banks have purchased 3 times more gold than they have purchased US dollars. I think he sees this event as a bit of a potentially trigger point for an acceleration of that trend. Now, I guess following that thread, we can talk about central banks buying more gold than US dollars. You mentioned it, the BRIC nations are kind of leading the way with this. I have to wonder if, China and Russia are stockpiling gold, if they're intending on one day supplanting the US dollar as the reserve currency. Is it not absolutely in the US's best interest to suppress that price of gold as much as possible, especially if their antagonists are stockpiling it? And how does that play out? What do you think?
Well, that's actually interesting as a question as well, because it's true that Russia, China, the BRICS are stockpiling gold in an accelerated fashion, because gold is still a diversifier to holding the dollar, even though the price of gold relative to dollars has been what we've seen drop. It's still something that's outside of that overall control. So yes, when you look at the Fed or look at the US coming in to buy more gold to sort of well, they're actually buying gold as well. So it's not so much a suppression of the price of gold, because that would also hurt the US purchase of gold. It's more like the US is needing or should be competing with the accumulation of gold, which ultimately and hasn't, because of the strength of the dollar relative to gold, ultimately should bring up the price of gold. I know there's a lot of talk out there about this manipulation and suppression of gold prices, and I'm not saying that can't also be happening. But on the broader basis, if we kind of look at gold as a geopolitical play, as well as, a sort of potentially physical currency play, it makes sense for the US to both suppress the idea of it being connected to any currency, suppress the idea of ever standardizing gold relative to any currency, which the US does all the time. And again, I have examples of this throughout my books, and buying gold to be a player. Okay, I'm with you there. And thank you for clarifying, because you're right. US is also stockpiling gold, and maybe more so than we know. That would be a smart move right now. I want to pivot to the idea of central bank issued digital currencies.
you've been speaking about this. Correct me if I'm wrong. You've been speaking about it in the context that this could be or create one of the biggest wealth transfers of our generation. Can you walk me through that thesis a little bit, Nomi?
So the main thing about a central bank digital currency, and specifically the Fed or the larger central banks creating their own currencies, is that to an extent it will disable the middleman of the banking system. Now, that's not to say that all of your bank accounts are going to go over to the Fed. The logistics of that would be nightmarish.
Yeah.
But in terms of opening accounts down the line, tracking transactions, bypassing the private banking system, and the private banking system, therefore, is not actually in favor of a central bank digital currency because effectively they know it can take business away from them. That can happen. And that's one of the reasons why the Fed's pushing it, gives the Fed more control over the creation of digital currency. I mean, we're just talking about gold for a second. It's way easier to create a digital currency than create gold, right? So, I mean, they can have their foot in both areas, but the reality is it's far easier to both create and to track transactions, and that includes taxation, that includes just anyone's transaction, and to take some of the sort of customer base ultimately, and this is not a tomorrow thing, but ultimately from the private banking system. And what that does as a whole is it actually solidifies the power of central banks, and that's one of the reason why even though I think central banks basically were behind the prevalence of Bitcoin and the cryptocurrency market in general, in terms of development, and perhaps that spurred them to push development of CBDCs more quickly than they otherwise would have. They would offer central banks, again, that much more power.
It would. And I think that's okay. So that makes more sense to me. When I hear people talk about central bank issued digital currencies and they're opposed to them, the most common opposition I hear from a dystopian outlook is that these are going to become massive surveillance tools. They're surveillance tools disguised as a currency. And I understand that concern and I don't like it. Having said that, I feel like that ship sailed a decade ago. If you're on Apple, Google, Facebook, Instagram, heaven forbid TikTok, everything we're saying right now, even if we're not recording, it's being recorded. My phone has to hear everything I say, just in case I say, hey, Siri, and then it can turn on, right? And so we know this is occurring. We know our keystrokes and our key rhythms are being recorded. Everything I type to you, every email I type is being recorded and analyzed, right? Our IP addresses, regions. So the surveillance ship, like, give me a break. We accepted this a long time ago. And I kind of feel like that's just a head fake and it doesn't. So we get absolute visibility into all transactions with CBDCs. Well, we're pretty much there anyways, right? Like maybe there's the odd thing that they're not seeing, but like what, I mean, I don't think that's the real threat. Do you think I'm missing something there, Nomi? Because like I said, I feel like that ship sailed a decade ago and all of a sudden now we're making a stink about it, but we've already accepted that outcome. What do you think?
You know, it's funny when as you're talking and throwing up your phone there, so last night I had some friends over and we were, you know, kind of chatting, and I've got, probably listening to this conversation right now, I've got Google set up, you know, to do things around my house.
Yeah.
And one of them couldn't find their phone. And then like 2 minutes, you know, it's like, where's my phone? Literally, where's my phone? It wasn't even me. And then like 2 minutes later or less, I get a message on my phone saying like, you know, something to the effect of, if you have trouble finding your phone, this is a way to help you. And it's like, wait a minute, it wasn't me.
Yeah.
I didn't say it.
Yeah. Doesn't matter, does it?
It just doesn't matter. I mean, we all know this. We all know things we say then get followed around by advertisements and things that can help us, quote unquote, and whatever. And you're right, that has been happening. That will continue to happen. It's also the case where the private banks, the big banks, are so connected to the government that, for example, if you're late on your tax bill, you will get your bank account basically, you know, frozen.
Garnished. Yeah.
Or garnished or whatever, in order to pay that bill at a point. So, and that relationship has existed for a long time. So on all those bases, our lives and our desires to potentially be separate from what we say and do financially with how much they are actually connected to banks and to the government is just not the same. And you're right. I mean, on that aspect, the ship has sailed. I think and yeah, as I said before, the main thing that a CBDC does is give that much more power to a central bank in terms of the ease of creation of money. It
Mm,
does give power into that central mechanism if it wants to aggregate or track transactions, that yes, it could anyway, that Google can do, that Apple can do, that Chase knows, or Citigroup knows, or Bank of America knows.
yeah.
These things are all true. You know, what it does is kind of centralize some of that. It doesn't add, it doesn't change it. It's another spot where that information can be centralized. So it's not, but it's not the thing that I think is driving the evolution to CBDCs. I think the thing that's driving it is this ability, as our technologies change, as this field of what I call new money, which is crypto, it's Bitcoin, it's PayPal, it's just everything across the chain, changes relative to traditional banking, that central banks perceive themselves to need a way to control more of what's going out there from a sheer currency perspective, a creation of you know, quantitative easing perspective, whatever it might be, to have just sort of more control with respect to the what is now a broader banking system,
Yeah.
including traditional and non-traditional DeFi financial mechanisms. And I think that power drive, whether they articulate it or not, whether central banks articulate or not, is the number one reason, and actually the thing we should most fear, rather than the tracking of what we're buying and when we're buying it relative to a CBDC.
I 100% agree with you there. And I want to jump into that. And first, I have one more like opposing question to this. And this is, do you remember that super high functioning technology platform that was rolled out at scale that was created by a government? Like, that ever happened before?
Well, they're not that efficient. They have,
Like,
again,
are
they
they the
have the
ones to
power
build
to
it?
get there. Right, right. No, that's exactly right. They can create money when they need to. They can borrow money when they need to. They can trade the debt. They can trade the currencies. They can do all that. But the efficiency is not increased by all that power.
Right. I mean, I just don't see the leadership actually executing on this effectively. And that's the biggest barrier. I mean, what we're talking about here is maybe the biggest tech project at scale ever attempted, right? And maybe one or two, I know there's like 100 countries working on their CBDCs right now, Canada included. Payments Canada is building one out, but it's easy to put that on your website. It's a different thing to roll out a V1 product. And so I just like, how, Nomi, how would suddenly our leadership, our governments become so competent that they could actually execute on a project like this at scale and have it work? I mean, I just can't think of a previous example, or even one that's close.
Well, I mean, yeah, what's close is not so previous. It's you know, when the dollar, for example, was invented, when basically, you know, you took a bunch of bank notes across a bunch of banks, across a bunch of regions and states, et cetera, across the country, that were all trading with each other, and one bank note meant something in one city and nothing in another, and so forth. And you had this sort of centralization of the currency. But I mean, that's ultimately what you're talking about. You're talking about a once in a, I don't know, a couple of centuries event. We might be faster to that now because it is a technology driven possibility and event. But I think the main thing is, even if there is a CBDC from a technological perspective, how much will that become standard to all of our lives? And I think that, you know, as you're saying, is something that you have to imagine is not going to happen overnight,
Right.
or potentially for decades, or if ever, right? So I think that's what we're talking about. We're talking about the evolution of the dollar, or a currency of that nature, you know, the pound beforehand, et cetera, but mostly the dollar, because it came out of a fractured group of other types of bank and backed notes. But again, I think the technology is there. I think it can happen, but the idea that it's going to happen overnight is really giving a lot of credit to this environment,
Right.
you know, that operates inside the Fed or inside the government. I mean, I think these things just take.
They take time. And I guess, you know, step one would be getting buy-in. And it wouldn't be so hard to get people to opt into this. You know, if you phrase it like, I mean, we just talked about the necessity goods in our life, prices will continue to inflate. People are going to become more hurting. If somebody steps in and says, look, if you opt in to this new app or whatever, this new banking opportunity option. We're just going to inject a little bit of cash into your account on a monthly basis. And yes, this money performs a little bit differently. We have incentives to spend over there, disincentives if you don't spend over there. And if you don't spend it at all, we're actually going to discount it at 15% per month. So you better get out there and spend. Whatever they, programmatic money has a lot you can do. And I could see this being sold very, very effectively, especially when the economy is on its knees. And that would be the time to push something like this forward. So anyways, what do you suggest people do to position themselves for these potential futures right now with their bank accounts, with their portfolios? What are you doing, Nomi? Talk to me about that a little bit.
Yeah, so just there's a number of sectors which, again, I do see a lot of transitioning in and opportunities within the companies that sort of lead them. So I mentioned the energy space, and I do see that transitioning space from the standpoint of electrification, from the standpoint of the rare earths that are needed from a domestic protectionist perspective to effectively move into that space. I think lithiums, your nickels, your everything that can be done on a sort of more sort of deglobalized perspective, depending on the country. I think those areas will grow, though those mines and related miners will grow. I know that from an electrification standpoint, particularly in the Midwest in the United States, there are a lot of production and manufacturing companies that are actually being built. So that's an infrastructure situation as well, in order to be less reliant or pay as much for the kinds of fuels we have today. And as a result, they're going to just have an economic advantage when prices go up, or just in general, in terms of their technology. So energy technology, I think, is still big. From the new money perspective that we talked about, I, in general, always recommend people not have all of their money in one bank, not have all of their money in one brokerage, even if, you've had it forever and it's easy and you use it, but to kind of spread that around to the extent that, you can mentally sort of handle that, because, with respect to whether it's a CBDC at some point in the horizon, or whether it's just the high fees you might be paying at your bank and not even noticing, or the low savings account you got at one bank relative to another. I just think being diversified into opportunities, like even if it's in PayPal relative to, I don't know, Chase in your portfolio, that you basically expand into the areas that are a bit less traditional, and more involved with the DeFi space, but still connect people and transactions. So even though we've had a lot of downside in the recent market in some of those areas, I think that's because of the fear of the Fed raising rates. And again, as we talked earlier, I think ultimately a pivot or sort of neutrality there is going to bring that money and that investment back into those areas, because they are the technologies of the future. And I also think in some of the meta reality space, not necessarily the metaverse from a gaming perspective, but from a medical technology, from an energy technology, from an architecture technology. I mean, I think all of the developments that we're seeing in AR are actually very exciting for the future. And again, taking a huge hit.
Sure.
But that's when I believe you should be investing rather than staying away, as long as your time horizon is long enough to sort of handle that volatility.
Well, you just hit on the most important thing, which is time horizon. So what, you took a huge hit over the course of a few quarters. If your time horizon is 5 to 10 years, what are you sweating about? And, my channel is investor focused. We get that, right? So, but thanks for restating that, because it's so important. You can have conviction in an idea, know that your time horizon is 5 years, but if in 2 quarters that price corrects, you still question your conviction. You're like, where was I wrong? But, get some perspective, right? Sometimes patience is the best trade. Right? Did something really material change with the management or operation of the company, or the big macro trend that you're really betting on? And I'm with you. I'm so long human ingenuity, right? We're going to continue to see challenging times forever. Nothing new about that.
That's right.
But what's the long-term trend of human ingenuity? It's very, very positive.
No, that's right. And that patience, I mean, just to underscore what you just underscored, I mean, that is the reality. If a company is not a viable company, or they're committing fraud, they can't find a leader, they're whatever, they just fell apart. Obviously an investment there is something to rethink, and you want to sell and go home and take your losses. But if we're in a period where, in this situation, we've had, incredibly cheap and easy money for so long, part of which has elevated the market, and the sort of taking away of which has really, destabilized the market for now. you still got to look at those sectors that are going to come out ahead in the future. And it could take a year, 2 years, 5 years, 10 years, but you're looking at your portfolio back, like project yourself forward and be like, all right, let me look back at what I've made or what I would have lost by just getting out.
100%. Yeah. Yeah. Okay. I would just going to say that one more time. Time horizon, understanding your time horizon is so important. Understanding that you're not going to get rich tomorrow. Just stop trying. All right. A lot of people label themselves as investors and then think like traders, and it's to their own detriment, right? They focus on yesterday's news and tomorrow's forecast when it's like, that's not how the game is played. That's a go broke fast scheme. Very, very well, most of the time. Look, okay, I want to wrap it up with another call to action for your books. Nomi, you honestly are, I think, the best financial author in the business. I thoroughly have enjoyed all of your books that I've read. When I had former Mexican President Felipe Calderon and former Prime Minister of Canada Stephen Harper up at my show in Vancouver in May, and you were there. Thanks so much for coming. Collusion was a central piece that helped me get prepared to interview both of those two candidates, because your ability to storytell and get inside the minds of the decision making that occurs at the highest levels is really, really effective. And so I'm looking forward to Permanent Distortion. You can pre-order it on Amazon today. I'll blatantly promote this because I think it's a smart purchase for everybody and should be on everybody's bookshelf. Where else can we send people, Nomi, if they want to hear more from you?
Just come to my website. I consider it a kind of home, electronically speaking. So it's just nomiprins.com, and it's got lots of information and hopefully takeaways as well, in terms of what I'm doing, what I'm looking at, where I'm doing it.
Okay, I love it. Look, I appreciate you, the work you do, and thanks so much for coming on the show.
Thanks, you too, Jay.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.